Mm. Okay, so good afternoon, everyone. Welcome to today's training classes. Okay, so this series of training started last 2 weeks, and today is like a continuation of that section. So for those that missed the last section, I will advise you try to watch the recordings. So I think if you're on my Telegram group, I dropped the recording, the links to the recording on the Telegram group, so you can always watch it. Now, firstly, this training is brought to you by Trade.com. It's a forex brokerage firm here in Lagos, Nigeria. And the essence is to train people how to trade. And that's why I said this is the second module. We started the understanding of the basics in the financial market. We started that last 2 weeks, and this is like the continuation. Okay, so let's look at what we have today. So today we'll be looking at basically forex terminology that is within a currency code. So that's basically what we'll be looking at. Under it, we'll look at what we mean by base currency, quote currency, long short, flat squared, the bid and ask price, what is pip spread, long short, lot size, leverage, margin, forex order type, pending order, stop loss, and then demo trade. Now, these are what we'll be looking. Now, under reading the currency code, we'll be looking in details at all this terminology. So we'll start with the base, the quote currency, we'll look at the bid, the ask price, the pips, the spread. Now, let's start with the base currency. Now, uh, the last class we took, I mentioned earlier, anytime you want to trade forex, you you should understand as a trader that anytime you're trading currencies, when you're trading forex and you have an open position, you should always know that you are exchanging one currency for another. Now, you cannot say you just want to trade GPP without trading against another. So when you place or when you open a particular position in the market, you should always understand that what it means is you are exchanging one currency against another currency. Now, currency are always quoted in relations to other currency. Now, if you look at my slide, you will notice I have two different currencies here. I have the GBP, that's the Great Britain pound, and then we have the US dollar. Now, the first currency before this slash, we always call it the base currency. I repeat, anytime you see two currency pairs like this, the first currency after the slash, we always call it the base currency. Now, the base currency is the reference element for the exchange rate of the currency pair. Now, it always has a value of 1. Now, anytime you see the first currency always carry the price of 1 behind it, even if you cannot see it. So you need to note that anytime you're trading, that it always carries the value of 1. So what it means is when you have GPP USD, it means 1 GPP. 1 GPP, that's what it means. Are we still together? Okay, so let's continue. Now, the second listed currency, which is on the right, we call it either the counter or the quote currency. I repeat, the first currency, we call it the base currency. While the second currency, the one at the right-hand side, we call it the counter or the quote currency. So when buying, the exchange rate tells you how much you have to pay in the unit of that quote. I repeat. Now, remember, this first currency is the base currency. And anything you want to do is always referenced on this base currency. Now, what it means is if I decide to enter a particular currency pair, If I decide to enter a particular currency pair, what I am basically buying or what I am doing is always on this first currency. Now, if I do that on this first currency, what this means is that this second currency is telling a minute. What this means is that this second currency, which is the quote currency, is the exchange rate that I have to pay to purchase this first currency. I don't know if I'm making sense. So it means that if I want to buy, what I am buying is the currency that comes first, which is the base currency. Now, if I am buying the base currency, the amount of value I need to buy this base currency is always quoted on this second currency, which is the quote currency. So what this means is, and that's why I said the base currency always have the value of 1. So if the base currency have a value of 1, the price that we have here goes with the value of the second one. So what this means is 1 unit of GPP, I will need to pay 1.21228 of US dollar. And that's why I say 1.21228 US dollar, I will use it to buy 1 Great Britain pound. I don't know if this is making sense. Please, if you're understanding me, I want you to type in 1 on the chat box. If you understand this scenario, I want you to type in 1 on the chat box. If you understand this scenario, please type in 1 on the chat box. Okay, so okay, thank you. I want to a minute. Okay, I want to give an example. Let me be sure we get it. I want to give an example. A minute. So I don't know. Am I sharing my? Can you see a whiteboard? Am I sharing a whiteboard? I want to know. I want to know if I'm sharing a whiteboard. I want to share a whiteboard, then give another illustration. If you can see a whiteboard, please type. Please just put yes on the chat box. Can you see a whiteboard? Okay. Okay. Thank you. Okay. Okay, no problem. Okay, I don't know. Okay, so let me just proceed. I don't know why. Hello. Please, can you mute yourself, please? Mute yourself, please, so you won't distract the class. If you have any question, you can drop it on the chat box and I will read it from there. Now, let's go to the bid and ask price. Let's go to the bid and ask price. I don't know if we are conversant with a trading platform. But anytime you open a trading platform, it always comes with 2 different prices. You will see a sell price, you will see a buy price, and it comes with 2 different prices. Now, this is an example of Euro USD. Euro USD has 2 prices. Now, these 2 prices, one is always known as the bid price, another one is always known as the ask price. Now, if you look at the 2 prices, one thing you will understand about the 2 prices is one is bigger, one is more than another. Now, the first price which you see here, which is the sell price, you will notice that it is lower. We have 1.3456. Then we have the second one is 1.3458. Now, you will notice one is lower and one is higher. One thing I want you to know is to easily differentiate a bid price from the ask price. The bid price is always the lower price. The bid price is always the lower price. Then the one that is higher is always the ask price. Now, what exactly is the bid price? Now, the bid price is the price at which your broker is willing to buy the base currency in exchange for the quote currency. Remember, I said the price is always quoted in the quote currency, and that's why I'm using that definition. Now, the bid price is the price at which your broker is willing to buy. Listen, it is the broker that wants to buy from you. So the bid price is the price at which your broker is willing to buy the base currency in exchange for the quote currency. Now, this means the bid is the best available price at which the trader can sell to the market. Now, what this means is this. Let's assume you enter a position and you've entered a position on a buy and the price has gone up and you want to sell. Now, the question is, who are you selling to? You are selling to the broker. Now, the bid price is that price you are selling to the broker, which is always the lower price. But remember, that price that you are selling, another person somewhere else is buying it from that broker. So that is where we have the ask price. So the ask price is now the price at which the broker will sell the base currency in exchange for the quote currency. Now, this means the ask price is the best available price at which you can buy from the market. Now, when I say you are selling to the broker, what it means is, remember, the broker is just like a middleman. Is a middleman. Now, there's a broker here. We have different traders. We have different traders from different parts of the world. If me, I decide to sell it, all the trader needs to do is someone somewhere will be ready to buy it. So now, the broker, if I want to sell to the broker, I will be selling to the broker at a much lower price, which is this price, for example. Now, the person that wants to buy it will be buying at this price. Now, the question now is, the difference between the two prices is where we have this 2.0. Are we together? The difference between these the prices is where we have 2.0, and that is what we call something else, which we'll go to. Now, let me use a more easier example. I want to believe everybody know all these Bureau de change, Aboki that are out there. Now, let's say, for instance, I have dollar, I want to sell to an Aboki. I go and meet an Aboki. If I'm selling my dollar to an Aboki, now I will be selling it to him. It will give me at a lower price compared to if I want to buy. Now, you will notice that someone is buying, another person is selling. If you want to buy, it will give you price lower. It will give you a price higher. If you want to sell, it will give you a price lower. Now, that margin is where they are profit. Now, the same thing comes here. The broker is a platform provider. He has different traders all over the world trading with him. So what this means is, if you want to sell to a broker, you are selling at a much lower price, which is the bid price. And if you want to buy, you will now be buying at a much higher price, which is the ask price. And this is where the broker makes his money from. Are we together? So that is where we go. Now let's look at pips. Let's look at pips. Now, in looking at pips, one thing I want you to understand is, anytime you are using a particular platform, try to know after the digits how many numbers are behind it. After the digits, how many numbers are behind it? Now, some platform, after the digits, we have 5. Some platform, we have 4. Why some platform we have 5? Now, you need to first know. So some platform are 4 digits quoted, why some platform are 5 digits quoted. There is no difference in them. It is just you. Please do not unmute yourself. I beg of you. Do not unmute yourself. If you have any question, please drop it in the chat box, else you'll be disturbing others. If you have any question for me, please drop it in the chat box. Thank you. Okay, now, so anytime you want to use a platform, the first thing is you should ask yourself, how many digits is this platform quoted? Is it a 4-digit or 5-digit quoted? So, and the only way you can know this is just go to the platform and look at their currencies. Now, this is a 4-digit quoted platform. Why this is a 5-digit quoted platform. Now, if it is a 4-digit quoted platform, the PIP is always the last digit. But if it is a 4-digit quoted platform, the pips is always the second to the last digit. So in summary, to know your pips value, it is always the 4th digit after the decimal. So this is the decimal 1, 2, 3, then we have 4. This is the decimal 1, 2, 3, and we have 4. So the what's the name now? The pips is always the 4th digit after the decimal. But when you are doing this, you need to know that there is an exemption. And this exemption is for any currency that is quoted with JPY. It may be USD JPY, it may be Euro JPY, it may be AUD JPY. Any currency that is quoted with JPY, their prices are always different. And this is how it always looks like. So if you have currency quoted with JPY, then you will notice that the PIP is always the 2nd digit after the decimal. The PIP is always the 2nd digit after the decimal. Are we together? Now, this is just to be able to know the difference between the PIP and the pipette. This is to know the difference between the PIP and the pipette. Now, what exactly is the PIP? Let's look at the definition. When you see PIP, now PIP means percentage in points. P, the first P is percentage, I in, then P points. Now, this is the unit of measurement to express the change in the value between two currencies. I repeat, this is the unit of measurement to express the change in the value of two currencies. Now, let's say, for instance, a minute, please. So let's say, for instance, you entered this currency when price was, let's assume I entered when price was 1.1051. And the current price is now, let's say, 1.1064. Now, if we have this, as a trader, you need to be able to know how many pips price has moved. You need to be able to know. Remember, this is the point you enter the market. Let's say your entry price. You entered at this point, and this is the price. Now, to be able to know, all you need to do is you need to do a subtraction. What is the difference between these two prices? So if we look at it, the difference is am I correct? The difference is this. And what this means is this is either, or we have 13 pips. So this is telling us that price has moved from this point to this point by 13 pips. Now, this is how you know price movements. Now, this is in a scenario whereby the quotes or the prices are quoted in 4 digits. Let's look at a scenario whereby prices are quoted in 5 digits. So let's assume the entry price, let's assume uh oh, you can't see it clearly. Ah, wow. Let me see if I can increase the front. Okay, a minute, please. Okay, let's see. Okay, I hope this is much better now. So let's assume the price for this is now 1 point. We have 26831. Okay, let's just use this. And the current price is now 1.22684. So with this, now 846. With this, if we want to subtract it, we have 0.0001. Abi, is it 1, then 6 minus 5? Abi, now in this scenario, some if I ask now with this scenario, can someone answer me how many pips is this? Let me know. How many pips is this? Looking at this example, pips as moved in example, using the first example before. I want you to drop it on the chart. How many pips has price moved? Thank you. 1 pip. I love this. 1 pip. Yes, 1 pip. 1 pip. Because I felt someone would say 15 pips. Now that is perfect. Why do we say 1 pip? Because remember I said earlier, pip is always the fourth digit after the decimal. So any value after that is zero, is nothing. We ignore it. So I think that explains it. So this is 1 pip. I love that. 1 pip. So it means those that are following us are following us. I hope if you did not understand, please let me know. If you know that you are lost based on the explanation, please let me know. If you know you are lost, please let me know. And if you are okay, let me know. Okay, now let's go to the next one. Spread. 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 Now, what exactly is spread? Spread is the difference between the bid price and the ask price. Spread is the difference between the bid price and the ask price. And we explained this when we were talking about bid and ask price. So the difference between the bid price and ask price is spread. Now, spread, why is spread important? Why do we think, oh, sorry, as a trader, why do we think spread is important? Because brokers makes their money from the spread. So we call spread the transactional fee for placing a trade. The same way I use an aboki as an example. So now for every trade, and that was why when I was explaining bid price and ask price, I said if you sell a particular currency to a broker, another person is buying it from the broker. The only thing is the prices they are taking that transaction is different. So brokers try to add a little markup from the price someone else is selling with the price someone is buying, and that's how they make their profit. So if you look at my example now, for every price, this is the illustration if it is quoted in dollars. Now we are using Euro USD because we are assuming this particular price is quoted in dollars. I hope we are seeing what I let me mark it so that Now we are using I want to explain something, but remember we are using Euro USD here because it is quoted in dollars. Now the first digit is telling us every 1 point. This one, it means that if what euro is 1 unit of euro will be bought at $1 400 and something cents of US dollar. Now, if you have Japanese here in here, then it will be 1 point or one Japanese 100 and something Japanese yen, because remember Japanese yen is always one something more. So, and remember the currency here is what we use to measure it. So it means that if you want to buy 1 euro, you need to pay $1 14 cents. So this 14 here is 14 cents. Then this is 0.3 pips. Is 0.3. It is pips. Remember we said pips is the fourth digit after the decimal, so it's the pipette. And the last one, which is the fifth, it's at times we call it pipette, but it's minute. So the most important is the pip. So, and this is how prices are being quoted. So, and this is just a breakdown to understand. And as I said, the spread, the difference between the bid price and the ask price is the spread, which is how the broker makes their profit. So, and it's like the cost you pay for every transaction you take. So that is the spread. Now, let's look at the long and the short. Now, as a trader, when you're talking to trader, or when you're talking to maybe you find yourself amazed group of traders, you can hear them say Euro USD is long, or you hear GPP USD is short. Now, what does this mean? Anytime you hear the word long, what it means it is buying, price is buying. So anytime you hear someone telling you, I'm going long on Euro USD, what they are basically telling you is, I want to buy Euro USD. So it's just like another name for buy or sell. So if you hear long or you hear going long, what it means is I am buying. So if price is going up, then we're assuming you enter the market here. So if you enter the market here, it means you are in profit. Then at this point, you sell it. But if price fall below this level that you enter the market, then you are in loss. Now, if you now hear the word short, it means you are selling. So if you hear I'm going short on Euro USD, if you hear I'm going short on Euro USD, what it basically means is I'm selling Euro USD. And if you sell at this point here, and then price begins to drop, you make money. The moment you come here and you want to close your trade, what it means is you are buying it. You want to buy it back. You want to say, okay, I want to buy, I want to sell this to someone. So the broker is buying it at this point. That's what it means. So, and if this happens, then you also make money. Okay. Okay. Wow. You're not seeing my screen since. Uh-uh. Nobody is talking. I'm so sorry. Oh. Ah, wow. It's just one person that is really talking in the group. This is funny. Oh. I'm so sorry. I'm so sorry. And I'm really explaining, joining everything, hoping that you are all seeing this. Thank you. Thank you. Thank you. Thank you. Thank you. Thank you. So sorry for that. I never knew you were not seeing my screen. With all my diagram, there is God. Oh. Okay, let me clean it and then start all over again since you were not saying it. Okay, so now, as I was saying, when you see the word long, or you hear someone saying, I am going long on Euro USD, what it means is they want to buy. They want to buy a particular currency. So when you hear the word I'm going long, it means they are buying a particular currency. Now, this is the current price. This is the movement. Let's assume you are buying at this circle here and this line. Now, if you are buying, it means that you have a feeling. Why? The reason why you are buying is you feel that from this point, there's a possibility price is going to go up, it's going to appreciate. Now, when you buy at this point and price begin to appreciate, if you get to this point and you want to close your trade, what it basically means is you want to sell the trade you have bought at this point. That's what it means. You want to sell the trade you have bought at this point. The moment you're selling, it means you are selling it back to the broker. So when you sell at this point, you've closed your trade, and what it means is you make profit. But should in case from this point you entered, instead of price going up, price begins to come down. If price comes down at this point, it means you are losing money. Now, if you lose money and then you said, okay, when it get to this point, let me accept my loss. I don't want to lose more than this point. Now, what it means is the trade I have bought here, I want to also sell it at this point. You are selling it back to the broker. So if you close the trade, it means you sold it back to the broker. So this is just an illustration of how the market moves. Now, the other scenario is the short. If you hear the word short, or probably you hear the word I'm going short, what it means is you want to sell a particular currency. You want to sell a particular currency. Now, if you are selling, and we assume you are selling at this point, you enter a sell position, at this point. What this means is you have a belief. The reason why you are selling is you have a belief that from this level, price is going to continue to drop. Price is going to continue to drop at this level. Now, if price now begins to drop at this level, if you want to close your sell position, what you mean is at this point, I want to accept my profit. I don't belly full. That's what it means. At all, I ain't bad. I don't chop am. I don't belly full. Now, when you close at this point, you are buying it. What you sold here, what you sold there, you want to sell it and you want to buy it back to the broker. Now, that's what it means. So when you close it, you are telling the broker, come and buy what I sold here. So when you close it, you have given it back to the broker, and they will give you in exchange, they will give you the profit you have made. But if price from this point you entered, instead of price dropping and price begins to go up again, increase in value, it means you are losing money. Now, when you get to this point, what it means is, okay, I'm ready to accept my loss at this point. So when you close it at this point, you close in negative, and the difference between the movement here will be reduced from your capital. And then you are telling the broker, what I have sold, what I bought, I sold out to you. I'm ready to give you back here at this point. And then you sell it. So this is basically just an illustration of the decisions you make in the market. I hope this makes sense. I hope this makes sense. Okay, now let's look at the next statement. Now, anytime you see the word flat or squared, what does this mean? Now, you may hear some people tell you, oh, it's flat, it's squared. Now, what it basically means is anytime you hear this word, they are telling you, I have no open position. I've closed all my trade. I don't have any open position. So anytime I don't have a position, any open or any running position, I will say I am flat or squared. So closing a position, when I want to close a position, I have a position running and I want to close it, then I will say I am squaring up. Now, these are just terminologies we use in the industry. So when you hear me say I am squaring up, what it basically means is I'm closing my trade. So it's just the essence of this class is just to make us understand some terminologies in the financial market. Okay, now let's go to the next topic, which is lot size. Lot size. Lot size. Now, what is lot size? What exactly do we mean when you see the word lot size? Now, lot size, basically, I'm trying to look at how to explain. Lot size is the unit of measuring a transaction amount. When I mean a transaction amount. Now, let me use an example. Now, if I want to, let's assume I want to buy egg from those that sell it in bulk, in retail, not wholesales, now retail. Now, if I go to them, hardly will I see someone, those that sell egg in retail, hardly will I see them. And I go there and I say, I want to just buy one piece of egg. They will not sell for me. Else, they sell it in crates. Now, it means that egg, when you want to buy egg from them, you can't buy a single egg. You will buy it in crates. Now, the unit of measuring egg is in crates in that scenario. That is the same thing with lot size in forex trading. So forex trading is a way of measuring the unit at which you want to buy a particular currency pair. Now, it is not possible saying that you want to buy Euro USD and you are buying one. Now, you may be using small money, but the way they buy it, especially in the brokerage firm, they buy it in lots, and this lot is grouped into different categories. This lot is grouped into different categories. Now, the biggest is the standard lot, the mini lot, and we have the micro lot. So they cannot sell anything lower than micro. You can't just say, I want to buy one. So you want to buy it in units. Now, if I want to buy a micro lot, it is always in unit of 1,000. So it is either 1,000, 2,000, 3,000, 4,000, 5,000, 6,000, 7,000, like that. So it is always measured in that bulk, and we call it lot. Now, when we have this micro lot, this micro is in unit of 1,000. Then the mini is in unit of 10,000. While the standard is in unit of 100,000. So what it means is, before now, the lowest money I need to be able to place a trade is $1,000. So if I have money lower than 1,000, I cannot use it to buy or to trade forex. If I have any money lower than 1,000, I cannot use it. So the lowest I can trade is 1,000. Now, this 1,000 I say now, this one is let me put it here. So now this micro is now in goods. So if I want to buy the first one, which is 0.01, I am spending 1,000. If I want to buy 0.02, then it is 2,000. So if I have $2,000, I can buy it 0.02. If I want to buy 3,000, so the same way until we get to this point, which is 9,000. So what it means is, if I don't have up to 1,000 before now, I cannot trade forex. And the same way with when we get to this mini lot. So this mini lot, this is 10,000, this is 20,000, this is 30,000, this is 40,000, and like that, and like that, and like that. I don't know if we are still together. Now, I will say this. What does this mean? What does this mean? Now, if I have $1,000, and I want to trade and risk, I want to enter a trade. Now, what this means is, if I enter one trade using 0.01 and if price move 1 pip, if price move 1 pip my direction, now the value of that 1 pip is 10 cents. That's the interpretation. If I enter the market and I use 0.01, so it means I am risking 1,000. I'm trading with $1,000. If I use 0.01 and price goes my direction 1 pip, then I am going to make 10 cents. If it goes my direction 2 pips, then it will be 20 cents. If it goes my direction 3 pips, 3 pips, it will be 30 cents. At the same time, if it goes against my direction, that's how much I'll be losing. Now, if I decide to use a $2,000, which is 0.02, now if price goes my direction 1 pip, the value for this 1 pip, the value is 20 cents. So for every pips movement, if I use 0.02, is 20 cents. So if price goes 1 pip, 20 cents. If it goes 2 pips, 40 cents. If it goes 3 pips, 60 cents. If it goes 4 pips, 80 cents. So this is just the measure of movement per pips. So if I use 0.03, so if I use 0.03, and price move my direction 1 pip, then what it means is the value of that 1 pip is 30 cents. Now this is how it continues. Now let's assume I use 0.09. Who can tell me what is the value of pips? 1 pip will be valued at what if I use 0.09? 1 pip will be valued at what? Who can tell me? Drop it in the chat box. 90 cents, not 90%, please. 90 cents. 90 cents. Thank you. Thank you. So this is for the micro lots. So let me clean this. Oh, okay. So let's go to now for the mini lots. For the mini lots, if I use 0.10 and price move my direction 1 pip, the value of that 1 pip is $1. So if price move my direction 1 pip, I will make $1. If it moves against my direction 1 pip, I will lose $1. If I use 0.20, if price move my direction, it is $2. So for every 1 pip movement, it is $2 if I'm using a mini lot. If I use 0.03, 0.30, if price move my direction, then it is $3. Every pips movement will be measured $3. So that is for the mini lot. Now for the standard lot, for the standard lot, every pips movement 1.0, every pip movement is $10. So price move 1 pip, $10, 2 pips, $20, 3 pips, $30, 4 pips, $40. So, and if it moves against you too, that is how you'll be losing. If it moves 2.0, every pips movement is $20. 1 pip, $20, 2 pips, $40, 3 pips, $60. And if it moves against you, that is how you will lose too. And the standard goes to infinity, 9.0, 10.0, 100.0, 1000.0. It goes to infinity. So this is how you risk or trade in forex. And that is where the lot size come to play. Are we together? Are we together? Now, having said this, let's go to the next topic, which is leverage. Now, initially, if you look at my lot size calculation, what it means is the lowest you can trade with in Forex before now is $1,000. That was before. But this is one thing that leverage helps us with. And that's where we come to leverage. Now, with the advent of leverage, which is one of the services that a brokerage firm provides, leverage allows you. Now, what exactly is leverage? Leverage is the ability to control a large dollar amount of a financial instrument with a relatively small amount of capital. That's what leverage does. Now, remember, we said earlier that the lowest you can start with is $1,000. Now, if there was no leverage, you cannot trade with anything lower than $1,000. That's the truth. But because leverage came to play, that is why you can now enjoy and trade with $20, with $40, and the like. That is what leverage does. So leverage allows you to trade with a small amount, but you're controlling big money. So with $20, you can even use 0.01. With $40, you can use 0.02. Now, I will say this, let's explain better the advantage of leverage. Now, when we talk about leverage, as a trader, you can choose the leverage you want to pick. You can choose your leverage. Now, the lowest leverage we have is 1:1. Leverage is always measured in ratio. The lowest we have is 1:1. We have 1:50. We have 1:100. We have 1:500. We have 1:200. We have 1:300. I'm just jumping it. Now, if you are trading 1:1, it means that you want to trade with your capital. So it means if you decide to use a leverage of 1:1, then the lowest you can trade with, the lowest capital you can start with is 0.0, is $1,000 if you want to use a leverage of 1:1. So you can either use the lowest capital is either you have $1,000 or you have $10,000 or you have $100,000 if you choose a leverage of 1:1. Now, if you choose a leverage of 1:50, how does this work? Now, if I want to use $100,000 and I pick a leverage of 1:50, now how to know what you are controlling? You will now say 50 divided by 100,000. Who can tell me that? 50, drop it on the chat box. 50 divided by 100,000. Sorry. Sorry. 100,000 divided by 50. So it means that if you choose a leverage of 1:50, 100,000 divided by 50, sorry, 100,000 divided by 50, 2,000. So it means before you can place a trade, the lowest you have, if you choose a leverage of 100,000, is 2,000. That's the meaning. If you use a leverage of 1:50, the lowest you can have to trade is $2,000. If you pick a leverage of 1:50. Now, if you pick a leverage of 1:100, so let's do 100 divided by 100,000 divided by 100. That's $1,000. Now, let me explain what this means. What this means is if you are using a leverage of 1:50, Before you can use a lot size of 0.1, you must have $2,000 if you are using a leverage of 1 to 50. That's the implication. And that's why we are using 100,000. So if you use a leverage of 1 to 50 and you want to use a lot size of 1.0, you must have a minimum of $2,000. Now, if you are using a leverage of 1 to 100, now you can use the other ones. So remember, this 100,000 is the standard lot. We have micro, we have mini. You can use the other. I'm just using the example of if I decide to trade with the standard lot. So if you don't have up to $2,000, you can never use 1.0 lot if you use a leverage of 1 to 50. Now, if you are using a leverage of 1 to 100, now before you can trade with 1.0, that is the standard lot, then you need to have up to $1,000 before you can trade 1.0 lot. Now, if you are using 1 to 500 lot, so let's do the calculation. That would be 100,000 divided by 500. So with $200 at this point, so what this means is with $200, you can use a lot size of 1.0. I don't know. Are you understanding me? And remember, I said if you use a lot size of 1.0 and price goes against you 1 pip, it will take $10 from you. So if it goes against you 20 pips, who can tell me if price goes against, I'm using a lot size of 1.0. If price goes against me 1 pip, it will take $10 from me. If it goes against me 20 pips, how much will I lose? How much? Drop it on the chart. How much will I lose? If it goes against me 20 pips, how much will I lose? $200, which means I blow my capital. Now, I'm going somewhere. Now, what this means is this: leverage. The higher the leverage you choose, the better the opportunities if you make profit, but at the same time, the way you can risk your capital. Because if you are using higher leverage, what it means is it will be pushing you to enter more trade, because leverage is giving you access to higher funds. You can enter more trade, but at the same time, you are risking more. And unfortunately, as at now, we have a leverage of even as high as $1 to $2,000. Sorry, 1 to 2,000 at the moment. Let's imagine I now choose a leverage of 1 to 2,000. And if some brokers give it. Now, if I want to enter a lot size of what's the name now of 1.0, who can tell me how much do I need? How much do I need to enter? Who can tell me? Drop it on the chat. How much do I need to enter a trade of 1.0? Who can tell me? What's happening now? Are we not together? It means with $50, I can use a lot size of 1 to 0. That is, how did I arrive at this? 100,000 divided by 2,000. It means with $50, I can enter 1.0. Now, imagine I enter with $50 and price goes against me. How many pips? It goes against me 5 pips. What happened? I lose my money. And there is 1,000%. I am 1,000% sure that price will go against you 5 pips. Now, this is where the danger of leverage comes in. In Nigeria, you will hear people saying that, oh, I want, please give me broker, give me high leverage. But they never understand that what they are telling is Please, I want to risk more of my capital. That's what it means. I want to risk more of my capital. They don't know. So they will tell me, give me more leverage. I want higher leverage. But this is the risk attached to leverage. You will be able to enter the trade, but it is still your capital that will save you inside the trade. I don't know if I am confusing you, or if, please, if you understand everything I have explained about leverage, please say yes. If you don't understand, please say no, so that I will be sure that I have not even confused you more. If you understand, please say yes. If you don't understand, please say no. Okay, John said no. Okay, who else? I want to know if you understand. If you understand, please say yes. If you don't understand, please say no. So it's only two people that are really talking in the chat. Okay. Okay, let me explain again. I will quickly explain again, because Mr. James John said he does not understand. Now, remember when I talked about lot size, I said lot size can be grouped into three categories: standard, mini, and micro. Standard is the highest. And I said, if on a normal trading, if you want to use a standard lot, it means you must have a capital of $100,000. So without a capital of $100,000, you cannot use a standard lot. And the lowest you need to trade is $1,000. If you don't have $1,000, which is the micro lot, you cannot even enter a trade if there was no leverage. But when the brokerage industry came in, they came in with a service, with a solution, which is leverage. Now, what does leverage do? Do, and that's why I have it here. Now, it is the ability to control large dollar amount of the financial instrument with a relatively small amount of capital. That is, with your small capital, you can control big funds. And that's what leverage does. Now, I said leverage is measured in ratio. Leverage is measured in ratio. The lowest leverage you can have, the lowest leverage you can have is 1-to-1. Now, if you pick 1-to-1, what it means is I just want to trade with my money. I don't want to use anybody's money. I don't want to control big funds. I want to use my capital to trade, which is the best way. You won't be able to enter too much trade, and you will be able to secure your capital. But apart from 1-to-1, we have ratio 1-to-10. So we have, apart from leverage, we have different categories of leverage. We have leverage of 1-to-10, we have 1-to-50, we have 1-to-20, we have 1-to-30, we have 1-to-40, we have 1-to-50. But me, I just want to pick some key figures. So I will just pick 50. I'll pick 1-to-100. Then I'll pick 1-to-500. That is what I want to use as example. And also for the example, I want to use that if I want to enter a standard, I want to enter a standard lot size. I want to enter trade with a standard lot size. Sorry, I want to enter a trade with a standard lot size using different leverages. How do I manage it? Now, remember I said to enter a standard lot size is you need $100,000. Now, with leverage, if I choose a leverage of 1-to-50 and I want to enter, how much do I have in my capital? How much capital do I need to be able to enter 1.0? That's the question. So to do this, it will be 100,000 divided by 50, which is the value of the leverage here. So if you calculate it, if you use your calculator, do $100,000 divided by 50. So it means that with $2,000, I can enter a lot size of 1.0 with $2,000. I can enter a lot size of 1.0. Now, if I enter if I enter a trade with 1.0 using two and I have $2,000 accounts, before I can blow this capital, then the trade must go against me 200 pips. If I enter now, this is the risk of using leverage. Now, if I enter a trade, if I use a leverage of 1 to 50, and I have $2,000, then with $2,000 I can enter a trade of 1.0. But if the trade goes against me 200 pips, I will lose these $2,000. Now let's go to the second scenario. If I use a leverage of 1 to 100, how much capital do I need to be able to use a lot size of 1.0? So how to do this? It will be 100,000 divided by 100. So who can tell me how much that is? 100,000 divided by 100. 100,000 divided by 100. How much is that? 100,000 divided by 100. Thank you. 1K. Thank you. So it means that if I have $1,000, it means if I have $1,000, then I can trade with 1.0 if I am on a leverage of 1 to 100. But what this means is if the market moves against me 100 pips, I will blow my capital. If the market moves against me 100 pips, I will lose my entire capital. Now, if I use a leverage of 1 to 500, how much do I need to have in my capital in my account to be able to use 1.0? So to do this, that would be 100,000 divided by 500. Yes, anyone? Divided by 500. So what this means is with $200, I can enter 1.0 lot. That's what it means. With $200, thank you. With $200, I can enter 1.0. But what this also means is if the market goes against me 20 pips, I will lose my capital. If it goes against me 20 pips, I will lose my capital. Now, this is where, if you look at 20, 100, 200, which one is easier for the market to go against you? It is 20. But some people will still, that's why you see some people, they have $200, but they can use 1.0, but they are risking too much. Now, this is the danger of leverage. That is the danger of leverage. Now imagine you are now using 1 to 2,000. We have some brokers that give $1 to $2,000. Now, if you are using 1 to 2,000, what this means is with what's the name? What this means is with $50, you can enter 1.0. And if price goes against you 5 pips, you lose your capital. So this is the danger of leverage. Now, I hope how leverage works now. I hope we all understand how leverage works. Now, I will say this. Let's go to margin. Margin. Now, what exactly is margin? Margin and leverage, they work side by side. Now, the way margin works is this. Anytime you take a position in the market, anytime you take a position in the market, a certain percentage of your capital, of your account balance in the margin will be set aside as the initial margin required for that new trade. So it means that for every new trade you enter, they will set a particular amount aside, saying that, okay, in case you lose this money, this will safeguard the broker. And this percentage is determined by both the leverage you pick and the amount you're trading with. So it means that if you enter a trade, notwithstanding on your capital now, if you enter a trade and you're using a leverage of 1 to 400 and you use 1.0 lot, they will take $250 out of your margin to safeguard the broker. Now, the question is, how much do you even have in your capital? How much do you even have in your capital? So leverage, basically, as I said, is basically a certain percentage of your account balance in the margin that will be set aside as the initial margin requirement for every new position you place. I don't know if this explains better. Let me give us an illustration. Okay, I will share something with, I will share another slide to just quickly give us an illustration. I know the market is closed, but let me just share you the trading platform and just show you how it works on the trading platform so that you can understand better. Let me see even why the market is closed. If you can quickly do that. Mm, okay. Okay, I want to believe you can see my chart. Now, let's assume we want to place this trade. I want to place a buy position. Okay, the market is closed. So let's use pending orders. The market is closed. Now, if you look at this is the amount you are trading. This is the lot size. I said it started with 1,000. So if I decide to, now this is 1,000, look at the required margin. So if I want to use this 1,000, it means I'm using a 0.01. That's what it means. Now, if I use a 0.01, it means it's going to take $1.46 out of my account for this particular position if I place. Now, let me increase it to 100,000. This is 100,000. Look at how much it's taking. So if I place this trade, it will first take $145 for my account as the required margin to place this trade. If I use, let me say, 500,000. Now, 500,000 means I'm using 5.0. If I use 5.0, it's going to take $729 for my account for placing this trade. Let's use 10,000. Now, 10,000 means I'm using 0.1. It's going to take $14 for my account to place this trade. Now, this is how margin works. And as a trader, you need to be sure that do I even have sufficient capital to withhold all this? Because this is just initially. As the trade is going against your direction, this margin continues to increase. It continues to increase. So you need to understand this as a trader. I hope I'm making sense. Okay, so let's go back to our slide to continue from there. Okay. Okay. Now we'll go to forex order type. Now, anytime you want to place a trade, there are different type of order, the order type you can use. For every trade you place, there are different type of order. Now, what exactly is order? An order is an offer sent using your broker. Is an offer that is the offer that you are sending to your broker to open or to close a transaction. That is if that instruction is satisfied. So it's you telling you, it's like an instruction that you're giving to your broker that I want to do something on my account. So that's what we call an order. So it's an instruction you're giving to your broker that I want to either open or close my position. So now the order is basically divided into two. We have the market order and we have the pending order. Now, market order means that you want to enter the trade instantly at the moment. It's an order that, okay, whatever I am doing is as at now, instantly. But pending order is an instruction that I want to place this trade at a particular time. So, and under the instant order, it can either be a buy order or a sell order, an instruction to buy or an instruction to sell. But under the pending order, we now have different type of pending order. We have the buy limit, we have the sell limit, we have the buy stop, we have the sell stop. Now, this is under the pending order. Okay, so I'm going to be stopping my presentation here today. I don't want to bore us too much because I know I have given us so much information. So I want to stop here and give room for questions before we call it a day. So our next class will be starting from this other time. Any questions so far? Any questions so far? Okay. A minute.